Hey, it's Matthew Decker here with another Takedown Thursday. Today we're going to be talking about another bad premium finance design. Now, the reason that we're spending a lot of time on these premium finance policies is because if there's any transaction in the financial space that involves leverage and fixed products, it's something that you absolutely need to make sure is done right, because every time you add leverage, you add complexity and you make things less malleable. There's not as many chances to go back and fix something and make it work for you if it's been started off on the wrong foot and you've added leverage and introduced a bank into the concept. So before we get into the actual review here of this bad premium finance policy, I just want to really quickly give you an overview of exactly what premium finance is. So premium finance is where you go out to a bank, and typically you're going to get a bank to pay premiums on your life insurance policy. Now, the reason that the bank is going to pay premiums on your life insurance policy is because they're going to be attached to the death benefit and they're going to be attached to the cash value. So the bank gets to loan money to you against an asset that is extremely secure. In fact, it's more secure than real estate because all of these life insurance contracts are backed by cash held in reserve accounts at all these different companies. So banks love to loan against life insurance policies because they get to stay in a fully collateralized position at all times. Now, because of that, you typically are able to get pretty good rates when it comes to borrowing money from a bank to pay premiums on your life insurance policy. Now, why would you even want to borrow money from a bank to pay premiums on a life insurance policy? Well, traditionally, premium finance has been used for estate planning, where let's say you have a 20, 30, 40, $50 million estate, and when you pass away, the IRS comes in and they tax you at essentially 50% over and above the estate tax threshold. So right now that's around $22 million. So over $22 million, you're taxed at around 50%. Well, that's a hard pill to swallow, right? A 50% tax is kind of crazy. So one of the ways that that problem is solved is through using life insurance. And the reason that you would use life insurance is because you can buy death benefit protection for pennies on the dollar. So if you have a state tax liability of maybe $5 million, instead of just paying $5 million out of your estate, you can buy a $5 million life insurance policy. You can hold that life insurance policy in an irrevocable trust. And then when you do pass away and that $5 million estate tax bill comes due, instead of taking $5 million from your estate and maybe liquidating some assets and paying that to the IRS, you simply give them the death benefit on the life insurance policy that you've purchased. And the only thing that it's cost you is the premium on the life insurance in the first place, which is going to be much less than $5 million. Now, where premium finance comes into play is, well, what if you don't have to actually pay those premiums for the life insurance policy in the first place? What if you can get a bank to pay those premiums? And so that's where premium finance really started. And now, in today's environment, where interest rates are as low as they've ever been, and you can get really attractive loan provisions from banks, and you have indexed universal life insurance policies that can return anywhere from, let's say, 5 to 9% on average, and you're borrowing at maybe 2 or 3, you have an opportunity to borrow money from a bank, put it into a fixed product that's going to earn somewhere between 5% and 9% with a 0% floor. It can't go backwards. The bank is fully collateralized all along the way, and now you have an asset that's going to grow tax-free. It can be used tax-free in the future, and all you have to do to get it is essentially pay the interest to the bank on a yearly basis. And so we see a lot of big premium finance policies for now income generation, really using the bank's dollars to finance your own retirement. Well, that's all well and good if things are done right. The problem with these policies is they can get extremely complex, and it's not so easy to kind of compare one to another. And they typically are going to come with like really high commissions if they're done wrong. And so there's a built-in incentive for someone to propose a premium finance policy to, number one, people who probably aren't qualified. You have to have at least $5 million in net worth, and a lot of that needs to be liquid in order for this to make sense for you. But there's an incentive to propose this to people that maybe shouldn't get it in the first place. And then number two, there's an incentive to not design it well, because the higher the death benefit, the more the commission on these products, and that's something that we've talked about a lot on this channel. And so if you're going to do premium finance, You have to make sure it's done right. You have to be working with somebody that actually knows what they're doing. And you have to really have a good understanding of the mechanics of a premium finance policy. So I'm going to go through a design that I saw a couple weeks ago, and I'm just going to show you where things can get convoluted and where you can really get into some trouble. So I'll share my screen here and we'll just kind of go through this one step at a time. So the first thing that you'll notice is we are borrowing around $460,000 a year from a bank into this life insurance policy. This was assuming a fixed rate for 10 years, which, that doesn't really matter for the purposes of this discussion, but $463,000 borrowed each year. And then the things that we need to really pay in on are this loan interest payment. So the client is going to satisfy the interest payment on the borrowed premium every single year, which is why it starts at $19,000, then it goes up to $39,000, $58,000, $78,000, $98,000, $117,000, because as we borrow more money at a fixed interest rate, the interest payment goes up. That's pretty self-explanatory. So the first column that we really want to look at here is, what is this requiring from a yearly out-of-pocket cost standpoint? And it's this loan interest owed to the bank. So you can see, you can actually get into this particular design with a $19,600 out-of-pocket expense in year one. You've borrowed $463,000, and it only cost you $19,600 to essentially get a bank to pay all that money into your life insurance contract. It came with a pretty big death benefit, and you'll notice here that the cash surrender value equals the amount borrowed from the bank. So you don't actually have to post collateral in this particular transaction. And that's our first stopping point. Whenever we get into premium finance policies that are typically done wrong, and really that falls into two camps. They can actually be designed the wrong way, or they can be sold or pitched as something that they're not. Okay, so in this particular case, the problem is not so much with the design, it's more how it was sold and how it was pitched. This particular policy was sold as essentially free insurance with no risk because you don't have to post collateral. So let me show you exactly what we're talking about here. You borrow the $463,000, and there's actually $463,000 in your cash surrender value of the life insurance policy. The life insurance policy is held by collateral at the bank, and so the bank in this particular instance, after you make your interest payment, is in a fully secured position. And so it was pitched as free insurance, quote unquote. Free insurance. Okay, so that's the first red flag. If you're being pitched premium finance and you hear free insurance or no risk, you should run, and you should run quickly, because there's no such thing as free insurance and there's always risk. Okay, so let's get that clear. There's no such thing as free insurance and there's always risk. But what's really upsetting to me about this particular policy is in this loan paid off and income. Okay, so most of these premium finance designs, the way that you're actually going to pay the bank back is by taking a policy loan from inside the life insurance contract. So you're going to take a loan from the life insurance policy itself. Typically that loan is going to happen in year, let's say 12 to 16, somewhere in that time frame. It depends on how the policy performs. It depends on how much interest you've been paying or if you've been paying extra out of pocket. But just to make it simple, let's say that the loan exit occurs between years 12 and 16. So you take a loan from your life insurance policy and you send that money to the bank, and that pays off the total note on the policy. And so it happens internally. And the reason that I'm saying that a couple times is because you're not typically paying the bank back with dollars that come from somewhere else. The dollars to pay the bank back are coming from your life insurance policy. So it's a transaction where everything is kind of contained into the life insurance policy itself. If you pay the interest out of pocket and post the collateral, the loan payoff happens without the help of outside funds, okay? Without the help of outside funds. And that's how this particular policy was positioned. But what's really frustrating is when we look at this loan paid off in income, we can see here that $1.5 million is used to reduce the accrued loan from year 6 to year 7. So $1.5 million of the loan was paid off between year 6 and 7. And you can see that. Let me get rid of everything else here just so we know exactly what we're talking about. You can see that relationship. There's the 1.5. So 2.7 to 2.8, that's $1.5 million, right on the nose. Okay, so $1.5 million is used to reduce the accrued loan balance. And when you reduce the accrued loan balance, what does that do to your interest payment? Well, it takes it from $117 down to $54,000. Okay, so we're projecting a $1.5 million loan payoff here between years 6 and 7, which reduces the total loan balance, which then reduces the out-of-pocket expense. That's pretty self-explanatory. And that process plays out over the next several years. So we have another 551 payoff, 551 payoff, another 551 payoff, and you can see the total loan balance slowly dropping, which means your interest payment or the client's interest payment slowly drops. Okay, so let's pause here. The problem with this design is that's not how it was sold. This loan sheet that we're looking at, which is really just an Excel sheet where you can put in literally anything you want because you can't see the formulas behind this Excel sheet. It's been turned into a PDF. So you don't get a copy of the Excel sheet with the formulas, you just get a PDF, which means anything could be contained in that PDF. And that's a problem, but we'll set that aside. The real issue here is this was positioned as you're going to take a loan from your life insurance policy to pay the bank back. And the first loan is going to be $1.5 million. And then you're going to take subsequent loans of $551,000 over a series of years. And ultimately, voila, you have no loan balance, you have no more interest payments, and now this transaction is free and clear with no additional collateral. And look, you've got $4.7 million in your policy, $5 million in your policy. This is a phenomenal transaction, right? Well, that is phenomenal. The problem is it's not real. And the reason it's not real is because even though this was sold as a self-contained policy, meaning the bank payoff is going to come from the policy itself, it's not going to use outside funds. Unfortunately, that's how these numbers are working. And so oftentimes the way a transaction or a premium finance policy is sold is different from how the mechanics are actually playing out on the loan sheet, and that's a huge problem. It's a huge liability issue. That's why you got to be really careful, and you got to understand, number one, what the loan sheet is saying, and two, you got to trust who you're working with, that they're doing things the right way. So what's actually happening in this design? Well, you're borrowing the $463,000 a year for 8 years. You're paying this scheduled interest payment for these 9 years. You're not having to post collateral in order to back this transaction because the cash surrender value of the policy fully collateralizes this transaction. So what's the rub? Well, you have to pay $1.5 million out of pocket in year 6, $551,000 out of pocket in year 7, and then again in year 8, and then again in year 9, and then again in year 10. So all told, you're having to pay $3.5 million out of pocket plus the interest due yearly in order for this transaction to work the way that it's illustrated. And if you were sold or positioned premium finance as free insurance with no risk, and 3 or 4 years down the road, it turns out that it's not free. It's actually going to cost you $3.5 million out of pocket plus your interest payment. And that's if things go well, you're in a tough spot. And so we're trying to fix this policy for this particular client, but it's tough to do because once these types of policies are put into place, they're difficult to fix. They're difficult to mold. And there's more that's wrong with this, but I'm not going to go into it because it's on the bank side. And I just don't want to get into that in this particular video. We might get into that in future videos. But depending on which bank you're using, some banks will charge you prepayment penalties to get out of these contracts if you try to essentially cancel it early. And so these are all things that you have to be aware of. That's why we specialize in these types of contracts. And when we say we specialize in these types of contracts, what we really mean is we want to make sure that if you are interested in a premium finance design, number one, It's the right policy for you based on your net worth, your liquid net worth, and that you totally and completely understand the risks involved in the transaction and where this policy can go wrong and what we would do on the back end to fix things if they were to go wrong. You have to understand the transaction. And ultimately, it's actually pretty simple. You just have to be working with somebody that can explain it in easy to understand terms. Because if you're looking at a huge Excel sheet with 15 different columns and all kinds of huge numbers in there, and you can't see the formulas behind the cells themselves, it can be very easy to play hide the ball with this type of transaction if you're working with somebody that doesn't know what they're doing. So what I would tell you is, if you ever see these premium finance designs, you need to be paying attention to several columns, and I'll highlight them for you again. And if you're not paying attention to these several columns, you can be setting yourself up to get in a position where you really don't want to be. Okay, so the first column that you need to pay attention to is how much interest are you paying out of pocket? Okay, loan interest payments. The second column that you really need to be paying attention to, which you can't see on this policy, but we're going to put it right here, it's going to be the collateral that's required of you on a yearly basis. And since this policy is essentially fully collateralized in the first year here, we're not seeing that column. But on most policies, that's a column that's going to show up. And then the third thing that you really need to pay attention to is, how is the loan exit being achieved? Is it being forecasted using the policy, or is it being forecasted using outside funds? And if you can nail down those three columns and generally understand the risks and the rewards and benefits involved in premium finance, and you're working with somebody who knows what they're doing, I would recommend a CFP, because CFPs are fiduciaries not only in the securities world, but also in the fixed world. So just because you're working with a fiduciary in the securities world, this is a fixed product, and their fiduciary standard in the securities world doesn't necessarily carry over to fixed products. If you're working with a CFP, it does carry over. So you need to be working with somebody who knows what they're doing, who's preferably a fiduciary in the fixed world, who can succinctly articulate the risks, the benefits, and exactly what these types of transactions are going to require out of you. So hopefully this has been helpful. If you've been positioned a premium finance policy, maybe something that looks like this, I'd encourage you to go to our website, leveragewm.com. At the top, near the menu, you'll see a whole section that we've dedicated to premium finance, where we answer some basic questions and give you an opportunity to get in touch with us if you want us to help solve any problems, or if you just want to run by a premium finance design, if you want to run that by us as a third-party expert, we're happy to help do that. So again, hopefully this has been helpful. The one thing about premium finance you have to make sure of is that you're getting into it and it's done right on the front end, because it's difficult to fix it on the back end. So hopefully this has been helpful, and until next time, take care.